In the heart of Lower Manhattan, beneath marble halls and guarded vaults, lies an invisible mechanism that moves more money in a single night than most nations see in a year. It's called the Reverse Repo Facility, a sterile name that conceals its immense influence. Here, trillions of dollars flow in silence, resting in digital ledgers rather than steel vaults. Every evening, banks, money funds, and global institutions send their excess cash to the Federal Reserve, exchanging liquidity for the safety of U.S. Treasuries. It is not a transaction of need, but of precaution, a quiet ritual of financial control. Like the gold vaults of the past, it exists to anchor trust in uncertain times. But unlike gold, it is invisible, intangible, and purely psychological. In essence, it's where fear meets policy, where the desire for safety outweighs the hunger for growth. Few understand its scale, fewer question its purpose, yet it quietly dictates the rhythm of modern money. What began as a short-term tool to steady markets has evolved into something larger, a monument to excess liquidity, a mirror reflecting the unease beneath economic stability. To understand how this came to be, one must step back through history, to an era when money itself was tethered to something solid. In the early 20th century, the world's economies moved to the pulse of gold. Central banks stored metal to guarantee their currencies, and liquidity had weight, literally. But after wars, inflation, and political upheaval, trust began to erode. The gold standard collapsed, replaced by promises, then by policy. Money became an idea, not an object. And in that transformation, the Federal Reserve emerged as both guardian and architect of belief. Fast forward a century, and the tools have changed, but the psychology remains the same. The Reverse Repo Facility is today's vault of confidence, a place not for metal, but for digital pledges of safety. When markets overflow with cash and uncertainty, institutions flock there as medieval merchants once fled to citadels. The difference is that now, instead of fortresses of stone, we rely on servers humming beneath Liberty Street. And just as gold once controlled empires, this modern mechanism quietly controls global liquidity, unseen yet omnipresent. The origins of the Reverse Repo Facility trace back to crisis, as so many things in finance do. After 2008, when trust vanished overnight, central banks learned that liquidity was no longer just a resource, it was survival. The Federal Reserve began experimenting with ways to keep short-term interest rates under control while ensuring markets never again froze in panic. One such tool was the Reverse Repurchase Agreement, a transaction that sounds complex, but at its core is simply a way for the Fed to borrow cash temporarily in exchange for Treasury collateral. It was meant to be small, technical, and temporary. But as the years passed, crises multiplied, and temporary solutions became permanent foundations. By 2020, amid pandemic panic, the facility expanded beyond imagination. Trillions of idle dollars, searching for safety, flooded into it nightly. What began as a narrow valve became an oceanic reservoir. Economists called it efficiency. Historians might call it fear institutionalized. For every dollar parked in that digital vault, another dollar is withheld from the real economy, from risk, from innovation, from life itself. Yet the irony is striking. The facility designed to stabilize markets has become a symbol of imbalance. When banks and funds deposit trillions into the Fed's hands, that money stops circulating. It sits motionless, frozen capital earning interest while the economy hungers for movement. This is the modern liquidity trap. Money, abundant yet inactive, becomes a paradox. Too much to fail, yet too still to grow. It recalls the hoarding of gold during the Great Depression, when fear strangled commerce and prosperity slipped into memory. Then, as now, people sought safety, not opportunity. The difference is that today the hoarding is digital and the vault belongs to the state. The Fed pays interest on these deposits, meaning taxpayers indirectly fund the stagnation. A closed loop emerges, wealth concentrating at the center while risk disperses outward. It's a design that sustains control, not vitality. And while the numbers seem sterile, their consequences are profoundly human. Fewer jobs, higher debt, slower growth. The machine hums, but the world beyond it grows quieter. To grasp the full magnitude of this system, one must visualize the nightly ballet of trillions. As markets close, vast institutions transfer their surplus liquidity into the Reverse Repo Facility. In return, the Fed lends out Treasury securities, the world's safest asset, as collateral. By morning, the transaction unwinds, and both parties reclaim their positions, slightly richer by the sliver of interest paid. It is a flawless dance of mathematics and psychology, choreographed to maintain order in a sea of uncertainty. But beneath the elegance lies fragility. For if the music ever falters, if institutions suddenly decide not to participate, liquidity could flood back into markets uncontrollably, disrupting rates, valuations, and trust. The last time such dislocation occurred was in 2019, when overnight repo markets seized without warning and the Fed had to intervene urgently. The reverse repo facility was meant to prevent that. But as history reminds us, every safeguard creates its own shadow. The tighter the control, the greater the risk when that control fails. Sound familiar? It should. The pattern echoes across centuries. In ancient Rome, emperors debased their coins to stabilize collapsing economies, only to ignite inflation and distrust. In the 17th century, European monarchs borrowed heavily against future taxes, believing credit could conquer uncertainty, until debt itself became the new sovereign. Today, our empire is digital, and its lifeblood is liquidity. The reverse repo facility is merely the latest chapter in humanity's long quest to master trust. It is the algorithmic descendant of vaults, treasuries, and temples, each built to protect belief in value. But belief is fragile. When too many depend on the same institution for safety, resilience turns to dependence. Like Rome's granaries or Venice's gold reserves, the facility ensures stability, but only until the tide shifts. When faith becomes concentrated, the smallest tremor can shake the foundations. And in the invisible corridors of modern finance, faith, not metal, is the final collateral. The 21st century economy is built on invisible rivers of money, yet few ever see their source. Each night, these rivers are diverted into the reverse repo facility, where the Federal Reserve becomes both dam and gatekeeper. In theory, this keeps the financial system balanced, preventing excess liquidity from driving short-term interest rates too low. In practice, it creates a strange illusion of abundance, a world awash in money that never truly reaches the shore. Corporations borrow cheaply, yet small businesses starve for credit. Investors chase speculative returns while the real economy drifts beneath the surface. It's the same illusion that haunted the late 1920s, when prosperity seemed endless until liquidity evaporated overnight. Back then, it was margin loans and stock speculation. Today, it's overnight repos and algorithmic trades. The actors have changed, but the psychology endures. Safety, once a virtue, becomes a cage. And the reverse repo facility, meant to contain panic, quietly amplifies complacency. The system hums, orderly, mechanical, obedient, until one day it doesn't. At its core, the reverse repo facility represents a profound shift in how power operates. In the old world, markets dictated money's flow. In the new, central banks script the rhythm. The facility is not a symptom of free markets, but their replacement, a mechanism of managed liquidity that turns risk into policy. Trillions are absorbed not through competition, but through command. The irony is staggering. Capitalism stabilized by central planning. This quiet centralization echoes the mercantilist empires of the 17th century, when monarchs and trading companies colluded to control every ounce of silver and every ship's cargo. Then, as now, the goal was stability through control. But control breeds fragility. A system that never breathes on its own forgets how to survive without intervention. And so, markets have become dependent on the Fed's nightly reassurance, unable to self-regulate. The reverse repo facility, in that sense, is not merely a financial instrument. It is a psychological anchor for an entire civilization of debt. Without it, confidence itself might collapse. The deeper one looks, the more philosophical the mechanism becomes. The facility is not just about money, it's about belief, timing, and fear. Every deposit reflects a decision, to seek refuge in certainty rather than venture into risk. It's a collective expression of caution, multiplied by trillions. In ancient Athens, citizens hoarded silver drachmas during wars, paralyzing the very economy they sought to preserve. Centuries later, depositors lined up outside banks in 1930, their panic transforming into a self-fulfilling prophecy. The reverse repo facility is the digital evolution of that same instinct. Instead of crowds and panic, there are codes and contracts. Yet the psychology remains identical, the desire to preserve safety at all costs, even if it strangles growth. Economists call it precautionary saving. Historians might call it collective anxiety. Either way, it reveals a truth about humanity that our systems mirror our emotions. And when fear becomes institutionalized, even prosperity begins to resemble stagnation. But what happened next transformed the tool into a dependency. As interest rates rose in 2022 and 2023, the facility ballooned to over $2 trillion. Money market funds, wary of volatility, rushed to park their cash there, earning guaranteed interest with zero risk. The Fed, in turn, paid billions in interest, money that indirectly came from taxpayers. The public financed Wall Street's safety net while struggling with inflation and rising debt. It was a modern echo of the 19th century gold hoards when national treasuries paid dearly to maintain convertibility, even as citizens endured economic pain. The numbers may differ, but the logic is identical. Protect the system even if people suffer. The reverse repo facility became a quiet monument to this trade-off. Stability purchased with stagnation. Certainty funded by public cost. Each nightly operation reinforced a grand illusion that risk could be abolished, that liquidity could be controlled without consequence. But as every empire learns, control always extracts its price. The risks, though hidden, are immense. Should institutions suddenly withdraw their funds en masse, the liquidity tide would reverse violently, flooding money markets with cash and collapsing short-term rates. Such an event would ripple across global finance, through currencies, bonds, and derivatives, faster than any policymaker could respond. It would be a digital bank run without crowds or headlines, yet catastrophic all the same. In 2019, a smaller version of this nearly unfolded when repo markets seized unexpectedly, forcing emergency Fed intervention. That was a warning, one the world quickly forgot. The reverse repo facility, by concentrating liquidity in one place, creates the illusion of safety while magnifying systemic risk. It is the same paradox that doomed the Titanic, too large to fail, too rigid to adapt. One breach, one misstep, and the system's perfect symmetry could unravel. History's lesson is merciless. Concentration of trust always ends in its betrayal. 4 centuries later, the parallels are haunting. In the Dutch Golden Age, the Amsterdam Whistle Bank once promised the same kind of stability. Merchants deposited their gold and silver, receiving ledger money in return, a system praised for its reliability. For a century, it worked flawlessly. Then, quiet manipulation and overextension eroded its foundation. When panic finally arrived, the collapse was swift and irreversible. The reverse repo facility stands on similar ground, a masterpiece of trust, efficiency, and illusion. Its balance sheets shimmer with security, yet beneath them lies the same fragile human element that doomed every financial construct before it: confidence. The faith that tomorrow will resemble today, that the gatekeeper will never falter. But faith, like liquidity, is transient. And when the two intertwine, history begins to rhyme once more, from Amsterdam's vaults to New York's servers, from ledgers of silver to databases of code. Different eras, same dependency. Different tools, same fear. Beyond America's borders, the ripples of this mechanism reach every corner of the global economy. The reverse repo facility may operate in New York, but its influence extends through every currency market and sovereign bond. When trillions are withdrawn from circulation, the world's financial arteries constrict. Emerging markets, dependent on U.S. liquidity, find their funding costs rising. Global banks recalibrate their balance sheets, hoarding dollars instead of lending them. It is a silent tightening, a monetary undertow few can measure until it is too late. History saw a similar phenomenon in the 1980s, when rising U.S. rates triggered debt crises across Latin America. The cause then was visible. Today, it's buried within the digital infrastructure of overnight lending. Economies once ruled by gold shipments are now governed by data streams and policy levers. Yet the essence is unchanged, the dominance of one system shaping the fate of many. The reverse repo facility has become the new center of gravity, invisible, yet pulling the world's liquidity toward it like a black hole of safety. The more it absorbs, the dimmer global growth becomes. In essence, the facility represents the triumph of managed confidence. It allows the Federal Reserve to fine-tune the pulse of the financial system with surgical precision. Yet such control breeds a subtle arrogance, the belief that risk can be engineered out of existence. Economists once thought the same before 2008, when complex derivatives promised stability through mathematics. The results were catastrophic. Now, the complexity has shifted to policy tools and balance sheets. The danger lies not in malice, but in faith that the model works, that liquidity can be switched on and off like electricity. But history reminds us that human behavior cannot be programmed. Confidence moves in waves, not equations. The very act of believing the system is unbreakable is what makes it vulnerable. Like the magicians of old alchemy, central bankers now try to transmute uncertainty into order. But beneath the formulas lies the same human desire, to master chaos, to bottle the storm, and storms, by nature, cannot be contained forever. As liquidity concentrates within the Federal Reserve, the meaning of money itself begins to change. Once, cash symbolized opportunity, a tool for trade, creation, and expansion. Now it has become a placeholder for hesitation. Trillions sit idle, earning fractional returns, while infrastructure decays, wages stagnate, and innovation slows. The economy becomes a mirror of its own fear, abundant in capital, yet starved of courage. In the 1930s, John Maynard Keynes warned of this paralysis, calling it the liquidity trap. He saw that when uncertainty dominates, people prefer holding money to investing it, even if it yields nothing. The reverse repo facility institutionalizes that instinct. It converts mass anxiety into policy. In doing so, it freezes the very heartbeat of capitalism, risk-taking. Each nightly deposit whispers the same confession. The system no longer trusts itself. And without trust, money loses its velocity, turning from a force of creation into a symbol of collective retreat. The machinery keeps running, but the spirit of enterprise fades into silence. The parallels between financial control and social psychology are striking. Just as societies surrender freedom for safety, markets surrender risk for predictability. The reverse repo facility is that surrender codified in accounting form. It's the fortress built after too many wars, a monument to collective trauma. After 2008, after 2020, the world grew tired of crisis. A demand for certainty overwhelmed the appetite for volatility. And so, we built a system where nothing truly fails, but nothing truly thrives. It's reminiscent of ancient empires that walled themselves against chaos, only to decay from within. The Romans fortified their borders. The Chinese built walls. Modern finance built liquidity traps. All shared the same flaw. Protection became paralysis. The Fed's control offers comfort, but at the cost of vitality. When every risk is neutralized, innovation withers. Stability becomes stagnation. And as with any empire built on caution, decline comes not with a crash, but with a slow, imperceptible loss of energy, until the silence feels like safety itself. But what if that silence hides something deeper? Beneath the calm surface of the reverse repo facility lies a slow erosion of autonomy. When markets rely on the central bank for direction, they lose the instinct to adapt. Price discovery, the fundamental heartbeat of capitalism, becomes artificial. Rates no longer reflect human judgment but policy calibration. This is the subtle tyranny of modern finance, control disguised as equilibrium. It recalls the managed economies of post-war Europe where central planning promised fairness but delivered rigidity. The difference now is sophistication. Algorithms and balance sheets replace committees and quotas. Yet the essence remains identical, a system where freedom is rationed in the name of stability. The reverse repo facility, in this sense, is the invisible bureaucracy of money. It hums quietly, efficiently, beyond the reach of public debate. And like all bureaucracies, it expands until it defines the world it was meant to regulate. The question is no longer whether it works, but what it has replaced. The consequences extend beyond economics. When liquidity is hoarded and risk sterilized, society itself changes. The culture of ambition gives way to a culture of preservation. Innovation becomes incremental, entrepreneurship bureaucratic. People sense it subconsciously, the stagnation of movement, the weight of unseen caution. In the 1950s, sociologists warned of the organization man, the worker who traded creativity for corporate security. Today, the financial system embodies that archetype. The reverse repo facility is its monetary equivalent, a safe, sterile holding pattern for global capital. Yet history suggests that prolonged safety breeds unrest. When wealth ceases to circulate, inequality widens. When opportunity is deferred, discontent festers. The same forces that once led to revolutions now simmer beneath digital surfaces, unseen but alive. Money, after all, is not neutral. It carries human intent, and when that intent is locked away each night, the system's pulse weakens. It becomes orderly, yes, but disturbingly lifeless. Every empire ends not with a single collapse, but with a gradual loss of faith. The reverse repo facility may seem far removed from such grand arcs of history, yet it embodies the same principle. It is faith, institutionalized and mechanized, replacing belief in markets with belief in policy. The British Empire once trusted its navy to maintain global order. Today's empire of credit trusts its central bank. But both rely on perception more than power. If confidence in the Fed's omnipotence ever falters, if investors begin to doubt that liquidity can always be managed, the illusion unravels. Like gold once fleeing the pound, capital would surge in unpredictable directions, seeking new anchors of trust. That moment would not be loud or cinematic. It would be quiet, like the dimming of a light. Systems this vast rarely explode. They dissolve, molecule by molecule, as belief dissipates. History's warning is clear. When control replaces confidence, and faith becomes centralized, decay begins the moment doubt returns. From a psychological perspective, the facility reflects humanity's deepest paradox, the craving for order in a world that thrives on uncertainty. We build systems to remove risk, yet risk is the source of progress. We demand stability, but innovation is born from imbalance. The reverse repo facility is our collective compromise, the cage built to house volatility. It allows the financial world to sleep at night, but only by suppressing the very forces that make it alive. It's the same paradox that defines civilization itself, comfort purchased with confinement. The ancient Egyptians controlled the Nile with dams and rituals. We control liquidity with code and policy. Both feared chaos more than stagnation, and both paid the price. For every drop of order we gain, we lose a spark of spontaneity. The system endures, but at the cost of imagination. And when imagination fades, societies like markets begin to forget why they exist at all. But what happened next, throughout history, is almost always the same. Once control becomes too perfect, cracks appear in unexpected places. In the 1970s, the Bretton Woods system collapsed not from rebellion, but from exhaustion. The promise of fixed exchange rates became untenable against human complexity. Today, the reverse repo facility plays a similar role, enforcing stability in a world that no longer fits the model. It functions flawlessly until the world demands something it cannot supply: organic growth, real risk, genuine discovery. At that point, no amount of policy precision can substitute for vitality. The machine hums beautifully until it meets reality's friction. And when it does, the adjustment will be swift, unplanned, and irreversible. Just as Bretton Woods gave way to floating currencies, the modern regime of managed liquidity will eventually give way to something freer, perhaps more chaotic, but more alive. The question is not if, but when. 4 centuries later, we may look back on this era as one of extraordinary ingenuity and hidden fragility. Future historians will marvel at how humanity created digital instruments capable of commanding trillions with a keystroke, yet could not summon the will to use that power for renewal. The reverse repo facility will stand as both symbol and symptom, the pinnacle of efficiency, yet the embodiment of fear. It reveals how modern civilization measures progress not by creation, but by containment. The ancients built pyramids to defy time. We build liquidity traps to defy risk. Both monuments speak to the same impulse: control over uncertainty, permanence against entropy. And yet, every monument, no matter how grand, eventually becomes a ruin. What remains is not the structure itself, but the lesson carved within it: that security, when absolute, becomes indistinguishable from paralysis, and that even the most sophisticated system cannot escape the gravity of its own design. In this light, the reverse repo facility is more than a policy tool. It is a mirror held up to modern humanity. It reflects our evolution from traders and builders into custodians and managers. We no longer conquer frontiers. We rebalance portfolios. We no longer chase the unknown. We mitigate its volatility. And yet, deep down, the same instincts persist: the urge to explore, to create, to risk. The tension between these forces defines our age. The Fed's vault is not just filled with liquidity. It's filled with restraint, a collective hesitation masquerading as wisdom. But history suggests that hesitation never lasts forever. Sooner or later, the pendulum swings back. The same ingenuity that created this vast financial mechanism will eventually seek liberation from it. The only question that remains is whether that transition will be orderly or explosive. In every age, renewal begins where control finally ends. So here we stand, in a world of silent trillions and invisible currents, where stability hums like a machine beneath the city that never sleeps. The reverse repo facility continues its nightly ritual, exchanging fear for safety, liquidity for stillness. It is both masterpiece and warning, a reminder that control without courage leads only to inertia. Like the vaults of Rome or the ledgers of Amsterdam, it will one day become a relic of its own perfection. And when that day arrives, the historians of tomorrow will trace its outlines, searching for the moment when safety became our greatest risk. Perhaps they will see it not as failure, but as evolution, the inevitable cycle of creation, caution, and renewal. For beneath the marble halls of finance, beneath the code and the numbers, lies something profoundly human, the eternal struggle between fear and freedom. And as long as that struggle endures, the story of the reverse repo facility and the fragile empire it sustains will remain unfinished.